Hey everyone, welcome back to Corporate Decoder, the place where we decipher what companies are really up to. Today we're diving into Northwest Bancshares' latest quarterly report. It looks like they're trying to impress everyone, but let's see if the numbers actually back up the hype. Think of it as financial foreplay, all the build up, but will it deliver? Before we get started, if you're into understanding the hidden language of corporate filings, subscribe to our channel. We also have a Discord community linked in the description below. Come join the decoding fun. First up, the financial health check. Let's take a quick peek at their balance sheet, or as I like to call it, the corporate selfie. Total assets are sitting at $14.5 billion, slightly up from last year. Not bad, but is it impressive? Loans are the bread and butter of any bank, and Northwest Bancshares is no different. We can see that loans receivable, after setting aside money for potential losses, are at $11 on billion-dollar year. That's a slight bump from the end of the year. On the other side of the equation, deposits are what fuel the lending machine. Their non-interest bearing accounts are at $2.6 billion, which is pretty solid. It means people are parking their cash but not demanding interest payments. Cheaper money for the bank. Alright, let's move on to the real action, the income statement, the money they're raking in. Their total interest income is $180.66 million, and net income is $43 million. Not bad, but let's find out why that's happening. Basic earnings per share are 34 cents, a good way to see if management is taking care of its investors. Now, they also had some other comprehensive income of $12.4 million that can be unrealized gains and so on. So that also boosted their performance. But don't get too excited. There's always a catch, right? They set aside $7.9 million for potential loan losses. It is important to look into in the long run. Digging into shareholders' equity, we see additional paid-in capital around $1 billion. This basically shows the amount investors paid above the par value of the stock. Cash from operations is at $107.6 million, so it looks like they have decent cash generation. One thing that boosted their cash was selling loans they were holding. They sold more than $42 million worth of loans, so they basically played the loan flipping game. On the other hand, they spent less than $2 million on their properties, keeping expenses low. Deposits increased close to $30 million, meaning they are doing something right in the market and people are trusting them with their money. Alright, now let's try to understand what is being cooked in these financial statements. Northwest Bancshares operates 141 community banking offices. That gives them a decent footprint in their operating area. They also own a few smaller capital and investment entities. Looking at their securities portfolio, they have a lot of money tied up in mortgage-backed securities, $1.1 billion. They are riding the housing train. Here is a key detail. The market value of their held-to-maturity securities is less than what they are carrying it on the book. Those are unrecognized losses. This is something that they cannot ignore for too long because you never know how the market will play. Okay, time to check their loan quality. Here we see non-accrual loans. These are loans that the bank is not confident it will be paid back on time. It's about $59 million. You want to watch those carefully. I noticed that their collection expenses are fairly minimal. This shows that they are not working too hard to get the money back. They have a decent amount of assets measured at level 3 fair value. It's roughly $1 million, and that's just based on unobservable inputs. These numbers are very subjective. It looks like almost all of their held-to-maturity securities are of high quality at AA+. Diving into their investment strategies, a lot of their available for-sale portfolio is tied to mortgage-backed securities. This might lead to a very concentrated exposure to the housing market, and they have to manage that carefully. Interest on mortgage-backed securities is up compared to the last quarter, about 43% in total. This explains why that section of the portfolio is generating good income. Diving into shareholders' equity, the exercise of stock options has brought in some extra capital. Nice way to bring in some extra cash and not bleed value since the option have already been issued. A net decrease in short-term borrowings shows that they're being conservative and trying to be self-sufficient by using their own funds. The statement of comprehensive income reveals accounting adjustments. They are basically tweaks and adjustments for assets for a prior period. Okay, now it's time to look into their own accounting policies. From that, they have close to $1.2 billion in debt securities amortized cost. So they will have those for the foreseeable future. They better make sure the quality of that is top-notch. The loans are split pretty evenly, close to $6 billion of personal banking versus close to $5 billion in commercial banking. They have $120.8 million in allowance for loan losses. It shows they know some of those loans are not great. They have unrealized losses, so the value of those investments declined. It's a pretty big number, close to $250 million. We see merger and restructuring expenses in these reports, most likely related to the news they will acquire Penns Woods. And here is the reveal: they had close to $1 million in restructuring expenses. They have close to $400 million in goodwill, which is such a funny accounting word. I am never a fan of this item on balance sheets. It looks like they are paying more in interest than they are paying for income taxes. What a world we live in. Cash on hand is $353 and 2 million unders. Not bad, better than last year. Their equity is pretty stable. It looks like they have some legal accruals which might increase in the future. Finally, there is a reference to their risk factors. Nothing new or major here. Act alert and put on our Warren Buffett hats. Northwest Bankshares seems to be navigating a tricky environment reasonably well. They boosted profits and held on to a healthy level of deposits. The loan portfolio is very diverse and has a concentration in New York. What might go wrong? Real estate always does. All loan portfolio is very diverse and has a concentration in New York. What might go wrong? Real estate always does. TAM on the positive. They are definitely building out their commercial business. That will take some time to pay off if the economy cooperates. What should you watch out for? Well, these unrealized losses on those held to maturity securities could become a bigger deal if rates keep moving higher. In summary, Northwest Bankshares is profitable and has a lot of positives. Their performance is decent, but definitely watch for any more housing downturn. Alright, that was our dive into Northwest Bankshares. What are your thoughts about their future and risks in banking? What do you think about real estate loans? Let me know in the comments. If you found this breakdown useful, hit that like button and subscribe for more of these deep dives. Also, don't forget to check out the Discord in the description below. Until next time, keep those portfolios safe.